uncertainty both domestically and when it comes to the global trade front. All of this is weighing on the US currency, and that dovish speculation is really key, right? Swaps are basically more than fully pricing in a September move from the Fed, starting to look at the idea of a cut at July as well as a potential possibility. There's now additional political pressure on Fed Chair Powell and his board as well. So it's hard to see sort of a situation, I guess, where you see that big recovery in the dollar. And it's interesting, we've been sort of talking about potentially, even as US stocks are at record highs, maybe this is a better indication that the whole diminished appeal of US asset narrative is not quite done with yet.
Yeah, and on that other side of the dollar trade, of course, we have seen that immense support coming from emerging markets. We're talking about the best first half gains in years when it comes to EM bonds, stocks, and currencies. So EM assets seeing about $10 billion in inflows in the last 4 weeks alone. When it comes to EM stocks, we're talking about a rally of about 14% or so in the first half. When it comes to currencies, 18 out of 23 EM currencies are up against the US dollar. Really, that flight from US assets, perhaps, as you mentioned, Heidi, not necessarily away from US stocks, but traders seem to be diversifying away from the US dollar. We have seen, of course, treasuries, also a lot of volatility in that space, given President Trump's policies and, of course, the uncertainty over what's to come when it comes to tariffs. The Korean won also has been a big gainer in the overnight session, actually outperforming G10 currencies. South Korea's more than $200 billion sovereign wealth fund also making a big bet on North American investments, with the region accounting for more than 60% of its holdings. Korea Investment Corporation CEO Park Il-young told us exclusively why U.S. Treasuries are a key part of that strategy.
We are happy to the investment in the U.S. Treasury in a sense that the U.S. Treasury bond gives a very strong liquidity and stable returns, and also regardless of the short-term market volatilities, we are expecting the stable and the solid returns in the short term. So for the time being, we maintain our portfolio, the Treasury bond as the core portfolios. But in the longer term, we are mindful of any risks from the supply change from the investors, and also some policy uncertainties.
Long term, do you need to be rethinking that? How are you looking at your exposure to U.S. Treasuries longer term, and how are you looking at potential alternatives to U.S. Treasuries? Are there alternatives?
We are now reconsidering our asset allocation. We understand our long term the returns are largely depend on our asset allocation. So among the fixed income investment, we are also interested in investing the credit, and credit bonds and the structural bonds, along with the U.S. Treasury, and also more fundamentally, we are now considering to our asset allocation between the fixed income, the global equity.
Do you see alternatives to public fixed income? And would you be looking to increase your weighting into things like private credit, for example, and private lending? And what role do you see that part playing in your portfolio?
Actually, we just start with the investment in fixed income in 20 years ago. Now we diversified our portfolio to the alternative investment, including, as you said, private equity, and real estate, private credit, and the infrastructure. So we believe the alternative investment will be our core asset in our portfolio in the longer term. So we plan to invest continuously, very and steadily pace.
Park Ki-young there, KIC Chairman and CEO, speaking exclusively with Bloomberg's David Inglis. Time more for morning calls ahead of the Asia trading day. BlackRock Global Fixed Income CIO Rick Ryder says he sees more opportunity in the stock market at the moment than at the long end of the Treasury curve. He told us that he prefers growth equities over long-duration bonds, which are increasingly correlated to stock market moves and no longer act as a hedge. And Bloomberg's MLive team thinks that the rally in Japanese equities will likely slow. The latest Tankan survey is out in a few minutes. It's also expected to show a moderation in business momentum. Compare that to the MSCI Asia ex-Japan, which is headed towards its strongest quarter since the end of 2020. You can get more on that story, all the day's trading in our Markets Live blog. That's on the Bloomberg at MLIV Go. You can get that market rundown in one click. There's commentary and analysis from Bloomberg's expert editors, so you can find out exactly what's affecting your investments at any given point. This is Bloomberg.
Up-to-the-minute news,
technology news, geopolitical news,
economic news,
financial news,
bringing you the latest news in private markets
whenever,
and wherever it happens.
In Washington, Beijing,
Cape Town, South Africa,
Las Vegas,
Davos, Switzerland,
Rio de Janeiro, Brazil,
the south of France, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
We have breaking news out of Japan. We are looking at the Bank of Japan's Tankan survey of business sentiment when it comes to large manufacturers coming in at 13. The estimate was for that 10 level and also for a decline. But in fact, we are actually gaining ground from the previous month that came in, from the previous quarter that came in at 12. The manufacturing outlook also better than economists had expected, coming in at 12. The non-manufacturing index in line with estimates, declining slightly from the previous quarter at 34. The outlook at 27 is a little bit of a decline from the previous month, but all in all, it seems better than economists had expected. Large all-industry capex estimate also higher than economists had expected, and an improvement from the previous quarter, coming in at 11.5%. For more on the Tankan numbers and Japan's economy, and of course, the dampening from President Trump's tariffs, let's bring in our economics reporter, Yoshiaki Nohara. So, Yoshi, is it okay to think that the numbers are at least better than we had initially expected?
Well, that is true. That the important figure today is the 13, the sentiment among large manufacturers, which are mostly exposed to exports. So this is a good news for the Bank of Japan. But I would say that it's probably premature to assume that all the clouds are gone. Especially when you get comments from President Trump threatening new tariffs on Japan. But at least is the weaker Japanese yen at 145 at the moment helping? Well, yes and no. I guess the weaker yen is providing some floor to exports, but we're not seeing that's being a major driver for exports any longer. So you have to keep in mind that the weaker yen tends to help exporters, but are we seeing the kind of the same engine that we used to see years ago? We're not seeing that any longer. So what should we be watching out for next in terms of data points and broader eco trends that might inform how the Bank of Japan might be thinking? Well, as Sherry mentioned, that all the eyes are on trade negotiations between the U.S. and Japan. And next timeline, important to keep in mind, is July 9th, when the higher tariffs are supposed to kick in, barring a deal between the U.S. and Japan. So this, you have to remember that this is a live negotiations going on. There's no pre-written text for this talks. So everybody is watching every word and every development of these negotiations, and that's including the Bank of Japan.
We continue to talk about this perhaps virtuous cycle setting into the Japanese economy now. Do we have a firmer narrative to among company CEOs that this might be setting foot? Virtual growth in wages, people consuming more, demand that's actually led by the Japanese economy?
Well, I'm glad you asked that question, because there's a big question mark about that virtual cycle now, because you can confirm in trade data already that companies are choosing to cut prices to maintain the volume in exports. So
that is a key problem, right?
Exactly.
I mean, you have to raise prices, but we're hearing from Japanese companies that they actually don't even know how to do that at this point, after years of deflation.
Right. Well, that is a key point, because if you can't raise prices, and if you're absorbing the impact of tariffs to some extent by cutting prices, that's going to cut down your profitability, and that's going to limit your ability to raise wages. So that's concerning.
What's the expectation for the Bank of Japan's next rate hike then?
Well, I think the consensus is becoming that they will wait and see, next time as well, maybe throughout this year. That's what I'm hearing from some economists.
A Japan economics reporter Yoshiaki Nohara there. Let's take a look at the flip side when it comes to, of course, the weakness that we've seen play out in the last 6 months for the Bloomberg Dollar Index. In fact, the dollar index overall has had its worst first half of a year since 1973, and all indications suggest that that dollar weakness story will just persist, with the dovish expectations now being priced in for the Fed, potentially even for a rate cut in July. We're sort of in for a chance there, as well as some of the broader US-centric uncertainties when it comes to trade, as well as domestic fiscal policy. You're watching not much of a move when it comes to the Hong Kong dollar at this point, but we are seeing more expectations. Barclays saying that the Hong Kong dollar will gain in the late part of the second half on a Fed rate cut and more interventions as well. 7.85 per dollar is kind of the level that they're looking at in the short term, and further advances in the second half of the year. The Taiwan dollar is also one to watch, as we saw it slumped the most since May 2001. That's been fueling speculation that the central bank intervened to curb that Taiwan dollar strength as well. Dollar Taiwan rising as much as 2.5% in that session. This is Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If I were the Fed, I'd start thinking about going ahead and lowering rates. Real rates are very high right now relative to history. And of course, we have a pretty significant term premium built into the term structure of interest rates right now.
Didn't really think I had a problem.
I would isolate, self-medicate. Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findstreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
This is the Asia Trade. We're counting down to Asia's major market opens with a positive lead-in from Wall Street. Another record high for the S&P 500, Heidi, but of course a lot of caution given the trade tensions still in play. This as we continue to watch what's happening over in Hong Kong. We do have the flag-raising ceremony. Leader John Lee leading this celebration of 28th anniversary of the Hong Kong handover to China.
This is we continue to watch the situation when it comes to HKMA and what they're doing when it comes to the currencies as well, that defense of the currency peg. We're watching really the flip side of that extraordinary dollar weakness story that we've seen play out in the first half, the worst 6 months for the US dollar since 1973. Those pictures there of Hong Kong marking the 28th anniversary of the handover there. And we, of course, Sherry, continue to watch for how much further upside we could potentially see in these equities, especially that rally in Japan.
Yeah, we have seen 5 sessions of gains for the Japanese equity markets, but we do have a slightly stronger Japanese yen at this point, past that 144 level against the greenback. So perhaps a little bit more downside pressure for the Nikkei, down 0.4% at the open. And this, of course, as we continue to digest, as you said earlier, the sell-off in the U.S. dollar that has led to the Japanese yen seeing its biggest first half gain against the greenback in 9 years. We are digesting the June large manufacturing Tankan survey coming in better than expected at 13, and that's really led to bond futures falling after that estimate beat. But we'll be watching the JGB space because we do have an auction later today. We do have a 30-year auction later this week as well. Take a look at how Korea is also opening because we had seen the won outperforming Asian peers, optimism over potential trade deals. The Kospi was gaining for the first time in 3 sessions, and we continue to see those gains extended for second session with the Kospi up 0.6%, Heidi.
Take a look at how we're faring when it comes to Australia at the moment, Sherry, as this is a picture as we get really that slow, staggered start to trading when it comes to equities. We're seeing a pretty flat to sort of upside there. Watching some of the property developers as we see that rise in property stocks, property prices, I should say, again, climbing for a 5th straight month. There's the Aussie dollar just pulling back a little bit after quite a period of sustained strength in the back of that weakness in the US dollar story. 65.77 still where we're at, comfortably above that 65 US cent level. And taking a look at treasuries, as we had really a pretty decent quarter and a pretty decent month, I should say, the best month since February ahead of the jobs data this week. A very different picture to what we've seen with the US dollar, but of course a lot of these expectations now being solidified around Fed expectations and whether or not we get a first cut in September, potentially even a chance of it in July, Sherry.
Let's bring in Bill Campbell, portfolio manager at the investment management firm DoubleLine. Of course, Heidi was talking about the Fed's trajectory. What do you expect to see in the jobs numbers this week that could have implications also for the Treasury space?
Hi, thank you for having me. I think that there have been a lot of big stories over the course of this year. You covered the biggest one, the falling U.S. dollar. But more recently, on top of easing trade tensions and easing geopolitical tensions, we've really seen U.S. yields start to come meaningfully lower. And that's helped global yields, even in Asia. When we look at the JGB, long end of the interest rate curve there, come lower as well. I think that the Fed is going to continue their wait and see policy, as there are a lot of big questions not only for the U.S. markets, but for Asian markets as well, revolving first around inflation, where Jay Powell is taking a wait and see approach to see if the pass through from the tariff policy so far and the weaker dollar will eventually lead to higher near-term inflation outcomes. But balanced against that, we need to keep a very close eye on if the labor market starts to crack. I know the market, the forecasted expectations for this Thursday's non-farm payrolls numbers, 110,000 as of the last time I checked earlier today. I think that's about fair. I don't think the U.S. labor market is breaking in a meaningful way at the moment. We are watching rise in continuing claims, but we also have seen an increase in U.S. immigration policy that has allowed for the labor market to remain strong despite the lower headline non-farm payrolls prints. So I think when you combine all of that into the picture for the outlook for the Fed, it keeps them on hold through this summer, and then we'll get a better clue, I think, as we enter the fall, on both what the inflation outlook looks like, but also more importantly, what the growth outlook looks like. And the subdued growth outlook and the potential for, if labor markets do start to weaken, keep a September cut potentially on the table.
So if you have the Fed cutting rates without the U.S. economy crumbling, that will really help risk assets, right? What are the expectations of where the opportunities could be during that transition for Asia?
Yeah, I think, look, if the Fed starts to cut interest rates, the other item that we really should focus on is there's the passage of the U.S. budget bill that's likely to happen by the end of this week in the United States. So that will be a net positive for pushing forward fiscal stimulus. My concern is that if the Fed starts cutting interest rates into the end of this year with increased fiscal issues, we could potentially see further weakness on the dollar that's going to put upward pressure on currencies, especially in Asia. When I look across the Asian markets, I think, the real question is, are we going to see a CapEx cycle build up? I know the Tenkan numbers just came out and, they look decent, but when we looked at the May industrial production numbers from last night, there was still clear weakness across the export sector from Japan to Korea. I do think that the Bank of Korea has another cut or two left in it in this cycle for this year as growth for both Japan and Korea remains subdued. It is interesting that we continue to see China post PPI deflation. I think that is going to be a headwind for inflation in Asian markets as well as European markets. But one interesting aspect that in the currency markets, we are all focusing on the crosses with the dollar. But when we look at crosses versus the euro yen is moving up to near-term highs. Euro CNY is also moving up, to near-term highs. And that presents the other big market for exporting for Asian countries outside of the U.S. is Europe. And this gain in competitiveness due to the fact that the euro dollar is rising, I think is a potential net benefit for Asian markets.
How do you invest around sovereign bonds at the moment? Because clearly, this is not just a Treasury story, it's not just a JGB story. Is this a global sort of scenario when it comes to the longer end of the curve?
Yeah, I think we're avoiding the long end of the curve globally, where we prefer to be underweight across developed markets at tenors above 10 or 15 years. So really the super long end of the curve, whether it's Europe, Japan, the UK, as well as the US, we prefer to be underweight there. But what we do think is likely to happen is we think that a virtuous cycle is likely to start building up with capital flows moving away from just U.S. assets back into international markets. I think that is going to be, a net benefit to the global economy over the next year or so, with its with the best expression of that being in emerging markets. So emerging market local currencies are on the top of our list. We think they're undervalued, they're underowned. The emerging market allocation for many allocators has been on a back burner due to the large risks that that sector has faced historically. But we think that is undergoing a sea change at the moment. We think that large fiscal stimulus and the redirection of capital is only going to increase capital to emerging markets such as India, Indonesia, and other ASEAN, emerging market countries that presents very interesting risk return characteristics when we look out over the course of the next year and a half. So that's the next, outside of avoiding the 30-year, we are actually increasing allocations to our emerging market local currency strategies. And that's, we think, going to be a very interesting place for investors over the coming quarters to, maybe the next several years.
What about allocation to China?
We're still a little bit hesitant on the allocation to China. I think that we saw the decent growth so far this year was really supported by pull forward of fiscal stimulus. And then we need to watch very closely what's going to happen with the July Politburo meeting. It's my expectation that we're going to see maybe an underwhelming of what the expectation for fiscal stimulus is out of that meeting. And the reason for that is the better than anticipated tone of trades negotiations that are happening between the U.S. and China. China is going to save its bullets. When we look at the Chinese property sector, we continue to see stresses. We heard from the PBOC over the weekend that they pulled back on the explicit, their explicit messaging for near-term RRR cuts if necessary. They're pulling back on that dovish rhetoric as well, and that's going to, potentially slow growth at the margin. Now, that being said, I don't think you're going to have an imminent collapse in China. I think what they were trying to do was manage what potentially was a large exogenous risk of trade negotiations with the U.S., which are now trending a little bit better. But ultimately, I think a lower trend growth rate across the globe, especially the Asian region, is more likely. But I think this is really a capital flow story that not only international investment into the U.S. is going to find new places, but China is going to be looking to find additional markets, not only to sell to, but also to invest in. And as we know, China takes a long-term approach to investment. When they come in, they offer cheap capital financing, and that tends to be a net growth driver for the emerging market countries that partner with China.
Bill, great to have you with us. Bill Gamble is a portfolio manager at investment management firm Double Line. And a reminder, you can see live coverage, Sherry, of that major monetary policy panel later today from the ECB Forum in Portugal. That's moderated by Francine Lacqua at 9:30 p.m. if you're watching in Hong Kong. More ahead on the Asia trade. This is Bloomberg.